How safe is max-funded IUL, Indexed Universal Life? By the end of this video, you will understand that max-funded IUL can provide ultimate safety, not only safety of the institution compared to a lot of other financial institutions that a lot of Americans put money into, but also safety of principal, meaning whatever you set aside, you do not want to jeopardize or lose, but also any year that you make money, you want that to become newly protected principal, so you will not lose what you made in previous years when there's a market downturn in the future. So I'm Doug Andrew. I've been a financial strategist, retirement planning specialist now for north of 48 years. You probably have surmised one of my favorite financial vehicles to accumulate money tax-free and then be able to access that money tax-free and not necessarily waiting until you're over the age of 59 and a half, but anytime to be able to access money without triggering a penalty or tax. And then when you ultimately die, you can leave it behind and it blossoms, it increases in value and transfers tax-free. Okay, so in a series of educational videos, I talk about 3 sections of the Internal Revenue Code and 3 tax citations. Sections 72E, 7702, and 101A in the Internal Revenue Code have been around in one form or another for over 108 years that allows money in an IUL policy to accumulate tax-free. You can access money tax-free, and when you die, it blossoms and transfers income tax-free. I know of nothing else that does that. As long as you adhere to 3 tax citations, I call these like IRS hoops that you have to jump through, TEFRA, DEFRA, and TAMRA, and those are acronyms. So you can learn about those in other episodes, but one of the common questions I get asked, well, Doug, how safe are these IUL policies? And I love that question. So let's talk about safety of the institution first. When we talk about IUL policies, those are offered by the multi-trillion-dollar insurance industry, which is not only the backbone of America, but the backbone of the world, okay? If you study, you'll learn that this is where many banks and credit unions put 30 to 40% of their Tier 1 assets for liquidity and safety. I'll explain that in a moment. But let's go back to the Great Depression, okay? In the Great Depression, because many of these insurance companies that I put my money into have been around for 150 years or longer. They were around during the Great Depression, and they came through with flying colors. Why? Do you know that some real estate in the Great Depression dropped as much as 80% in value? So real estate wasn't the answer back then. Banks closed. 40% never reopened again. Do you know there was not one single legal reserve insurance company that went under in the Great Depression? Nope, not one. They came through with flying colors, maybe crediting, 2.5%, 3.5%, but people had access to their money in these insurance companies. So they weathered the Great Depression with flying colors. Let's fast forward to 2008 mortgage meltdown. A lot of Americans have no idea how close we came in America to a total financial collapse, okay? And that's why the government panicked. So in 2008, about 400 banks went under. 900 more were on the watch list, meaning on the brink of going under. And this would have caused a run on the banks in America. So the federal government asked the 5 major banks in America in 2008 to disclose where they had their Tier 1 assets. Now, a Tier 1 asset is money that banks and credit unions have to have on hand, liquid and safe. This can't be out in mortgages on homes that they have to then foreclose on a home like they did in the movie It's a Wonderful Life. No, they changed the rules. They can't just call a mortgage due unless you are behind, okay, for 3 months or more. And so they can't just go ask for money from you out of the mortgage on your house. So they keep Tier 1 assets that are liquid and safe in case there's a run on the bank. A lot of people want their money out of the bank. And so that's called a Tier 1 asset. And they disclosed that they had 30 to 40% of their Tier 1 assets in insurance companies. Why? Well, because most of the insurance companies manage way more money than the banks do, but they're way safer. Banks, they loan out money and so forth, and 80% of the value of a piece of real estate, and they give themselves a 20% cushion in case they have to foreclose. Insurance companies, if they loan money on real estate, like skyscrapers and shopping malls, they only maybe loan 50% loan to value. So they have a bigger cushion if they have to foreclose on a skyscraper or shopping mall. And that's why they come out smelling like a rose if they have to do that, because they are more conservative. If a insurance company invests in bonds, it's AA or AAA bonds. They don't loan it out in high risk type of investments or loans. If they put it in stocks, it's very carefully selected stocks, and it's usually no more than 10 or 15% of their general account portfolio. This is one of the reasons why the insurance industry and insurance companies that are legal reserve companies, that means they have reserves on hand that are liquid and safe in case the banks want all their money out of the insurance company where they put it, okay? They have to have liquidity. And so this is where they put their money, and that's how they've weathered the Great Depression. The banks know this. So this is where the banks and credit unions put their tier one assets for liquidity and safety. Now, if you're connecting a few dots here, let me just take this side trip. And by the way, make a comment or share this video with somebody else that would appreciate this information. But based on what I just said, why would you have any more money than necessary in some emergency fund in a bank or credit union if that bank or credit union paying you 1% or less is doing what with your money? Turning around and increasing the liquidity and the safety by maybe 5 or 6 notches higher in safety. See, most of these insurance companies are rated AAA, where I put my money. Most banks in America are only rated BBB. Now, AAA isn't 1 notch higher than BBB. It's like 6 notches higher in safety. So the banks are taking your money that you put in them and increasing the safety by 5 or 6 notches higher by putting it into insurance companies, and they're earning a higher rate of return of 4 or 5% tax-free, and they're only paying you 1%. How much more is 4 or 5 than 1? Don't say 4, it's 4 times, it's 5 times, it's 500% more. On every million you put in banks, they pay $10,000 a year in interest, but they earn $50,000 in the insurance company. You can bypass the middleman is what I'm saying and put your cash, even emergency funds, in insurance companies, because that's where banks put some of your money, okay? So back in 2008, when the 5 major banks said we have our money in insurance companies, in what form? Well, a lot of times it's in BOLI, B-O-L-I. So BOLI means bank-owned life insurance. Why? Well, they own insurance on who? They're stockholders, they're board members or whatever. But see, it's the owner of the insurance that gets all the tax-free accumulation and tax-free access, but they do it for liquidity a lot of times, okay? A lot of corporations in 2008 disclosed they had it in COLI. That's corporate-owned life insurance, okay? And that's true for my own corporation. So when we talk about it, max-funded IUL is safe with an institution, and these are the institutions that have weathered the Great Depression and the downturns like 2008. Now let's talk about safety of principle, the second concept. What I mean is, if I'm setting aside $500 a month, or $100,000 a year, or 500 grand, whatever I'm putting into my IUL policy, if that's earmarked for future goals like retirement, or college funding for my kids or grandkids, or my working capital for my business, I don't want to jeopardize that. That's serious cash to me. So the reason why I use IUL is because you have safety of principle. If I put in, let's say 500,000, or it grows to $1 million, I want that to be safe. That's my principle. And so I don't want to lose my principle due to market downturns. Indexed universal life allows you to be able to link to an index if you want any given year. And when you do that, then the insurance company has the wherewithal to be able to buy upside options because they take the interest they're earning on your money. And you said, you know what, just take the interest on my money, but don't jeopardize my money. Keep it safe. And so your principal is safe. That's safety of principle. If you had $1 million and it's earning 4% in the insurance company, you can just settle for 40 grand, or you can say, I'll give you that 40,000 and you buy upside options and pay me whatever the S&P does. And those options may double and they'll pay you 8% or 12%, but the insurance company has the wherewithal to pay you if the market goes up. But what if you guess wrong and the market crashes and it drops 40%? If you had your $1 million in the S&P or in the market, your million would go down to 600,000. But no, if you have safety of principal, then your million is still safe. You didn't risk your million in the market. It stayed safe in the insurance company. You have safety of principal. You may not have made anything that year because the options expired worthless because the market went down, but you didn't lose. Will Rogers once said, people get more concerned about the return of their money than the return on their money when things go bad, okay? That's called safety of principal. But the next concept will blow you away. You not only protect your principal, but let's say you had $1 million in March of 2020. And if you were a client of our firm, many of our advisors said, hey, the COVID-19 pandemic, the market dropped 30%. Linked to a one-year point-to-point with no cap index. I think your chance of making a really good return is great. And they did. 1 year later, in March of 2021, many clients got credited 61.33%. That means if you had $1 million in March of 2020, in March of 2021, your IUL policy would have had $1,610,000 in it tax-free. Now, if the next year the market crashed 40%, you would still have your $1,600,000. You would not lose one dime of the $610,000 that you made the year before. You're locking in the gain and you're resetting every year, okay? And so every year you make money, that becomes newly protected principal. You will not lose in future years money you made in previous years due to a market downturn. That is incredible. So that is safety of principal, and any year you make money, that also becomes newly protected principal. So you will not lose in future crashes money that you made in previous up years. You wouldn't believe how many advisors go, huh? How can you do this? And they're not taught this. And you can watch an episode on why advisors usually don't understand this. So that's the beauty behind the safety of an IUL policy. Safety of the institution and the industry, and safety of your principal. So make sure when you meet with an IUL professional that you can ask them questions like this, but you'll already know the answer to this one if you watch this episode. But you can learn more by reading and studying the book, The Laser Fund. This should be your textbook, and if you have not claimed your free copy yet, be sure and go to laserfund.com. That's laserfund.com. Click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll fire out a copy to you. And there's also options when you go in there to listen and learn and watch and learn, and you can even schedule an appointment with an IUL specialist. But I would strongly recommend you watch these educational videos so your conversation starts out here instead of down here, okay? But these pillars on the front stand for liquidity, safety, rate of return, and tax benefits. And an IUL policy that's structured correctly and funded properly scores the highest scores in safety compared to any other investments that I'm aware of.